Welcome back. Hey, look, I have been out of action. We've had a nasty dose of COVID in the household. And so it's put us a little bit on the back foot. I just wanted to go over some really interesting opportunities, particularly for income seeking investors. So I'm going to be starting a new series with more regular updates, more regular posts, particularly focusing around opportunities in areas such as closed end funds or CEFs. These are often used as an income generator vehicle. We'll talk more about them as we go through the series, and we're going to look for some really interesting opportunities here for long-term buy and hold investors. Right, so look, closed-end funds, we'll talk more about what they are later, but today I just want to have a quick look at the Special Opportunities Fund. Now, I'm going to use the Nuveen CEF Connect database here. They have collected a huge amount of specialist information here on closed-end funds as one of the larger closed-end fund providers themselves. Now, under here, we've got special opportunities. We can see one of the main characteristics here that many investors muddle up, I think, with closed-end funds is the way in which the NAV, the net asset value of the underlying assets, can be quite disconnected from the price. So we can see here, for example, that there's currently a 15% discount here. So essentially you can buy, the market price is 15% lower than the actual value of the holdings. We can see that there's a regular monthly distribution here of about 9%. Is this a good discount? Well, we can look at this in a very historical sense. Now, this has been around for quite a while in various guises, and we can see that generally prices have been disconnected from the net asset value. Now, what we see also is this trend with many closed-end funds, how the net asset value basically hasn't gone very far over since 1993. I think it was the inception date for the fund. And so we can see most of this distribution is being paid out on a regular basis as income rather than increasing the net asset value. Over the last 5 years, we can see, for example, in the COVID crash, that the net asset value decreased quite strongly and then rose up again with, again, prices not following quite as strongly. And there's been a few times here in 2020 during the decline period as well, where the net asset values declined at a rate that was faster than the prices. So that gives us this sense of the disconnect of this discount that we can actually buy. We can pick up the assets at a cheaper price. So when we begin to look at the fund, though, there's a couple of key elements here to keep in mind. Now, the talk about the fund objective being total return, I don't think there's a very good way of describing this. It's really a fund that is focused on income. And we saw that as well on the previous screen when we begin to look at the way in which the NAV hasn't really increased very much. So let's be honest, it's really more about the income. One thing to note is there's not a huge amount of liquidity in this fund. For many retail investors, that will not be a big problem, and I think this is true for most of the closed-end funds as well. Net asset values are relatively stable, but there's often not a huge number of shares outstanding, not a huge float, and the funds are often quite small. A really important point as well with closed-end funds is traditionally this has been a bastion of leverage and the ability for the fund to actually increase and enhance both yields and total returns with leverage. And this fund is no exception. Now, it's not true that all CEFs use leverage. I've got a number of holdings that do not use leverage. But this CEF Connect is a really great website here as well for just making sure that how much leverage is being used by the funds you're invested in. Now, this is really important because, my friends, leverage obviously works two ways. When things go good, leverage amplifies those gains and benefits. When things go badly, leverage is going to cut like a falling knife. Now, that's also important as well when we begin to think about the way in which the funds can be disconnected. The market price of the fund can disconnect from the NAV. A closed-end fund was trading at a premium, that is, the prices of the NAV. That means that with leverage, we can hit with a double whammy. We can actually be hit as the leverage increases the drop in the prices. So the prices can decrease from a premium to a discount very quickly. And in fact, it can actually accelerate that drop. And so we can double down, basically, the leverage can accelerate the rate of the drop, and we can move from a premium down to a discount. And so it can basically increase the magnitude of the drawdown there. So it's really important to note that leverage is reasonably common, but it is something to take with caution. Now, in this particular case, they've got, I think, some convertible shares that they issued, which provide them with a very low cost. I think it was 2.7% cost of capital here for the leverage. So it's a relatively low cost of leverage, particularly given the current environment of higher interest rates. Now, this is also important to note here. As I said, there's a relatively small daily volume. So the average daily volume in dollar values is not really a huge amount. So it's not $1 million. It's only about $250,000. So for most retail traders with a small individual or family portfolio, this will not be a big issue. But what it does mean is it means it's probably going to be unwise to place a market order. Use limit orders, use them carefully, pick up a good price, wait and be patient, wait for the prices to move to you. What we are often focused on is this distribution. Now, we can see a couple of key points from this chart. We can see for a long time there are annual distributions. They have recently shifted to monthly distributions, and we can see here in 2024 the distribution amount's gone up. Now, this isn't tripling a distribution. We do need to look at the excess here. So it's gone up from 8 and 2/3 cents per share to basically 9.5 cents per share per month. So it is an increase, but it's not a substantial increase. Now, one of the key things as well with CEFs as well, okay, Lincoln, that's all very well and good, but how much money is coming from what source? And this is another benefit here from the CEF Connect platform, is it very quickly and rapidly allows us to get a sense for what is going on here. And so, for example, we can go back in time a little bit and we can get a sense of where this income is being sourced from. So, for example, the most recent dates up here at the top, we can see that the distribution amount was entirely from income. And then when we get down to the January month, we can see some of the distribution was from income, some from long-term gains, some from short-term gains, and there was an element there of return of capital. Now, I know some investors shy away from the return of capital. It's not a simple case for return of capital is bad and avoid CEFs that have a use of return of capital. I think that has a place, and when it's being used sensibly and judiciously, as I think it very much is here, it's not too bad, but it is definitely something to keep in mind. And I know for some investors, this will be quite a turn-off. But if we look here, for example, there's not a huge use of return of capital, 4 cents on that month per share, 1 cent here, 2 cents here, 2.5 cents here, and so on. So it's being used very judiciously on top of, for example, long-term and short-term gains as well as income. So overall, seems to be the Special Opportunities Fund is a well-managed fund here from that respect as well. Now, the pricing here on CEF Connect, it gives us a sense of how disconnected the price is from net asset value. Now, we can see here, for example, that at the moment it's hovering around the 15% discount. It has been up to about a 5% discount in the 2021 period. And since inception, a bit of a messy chart there, but we can see it has generally traded there at that discount. Now, when we begin to wrap all this up, what does it mean? We can see here in the terms of the portfolio that over a 10-year period here, the price in light blue, the NAV in dark blue, it's underperformed their benchmark here in terms of the category that they fall within. It's not I think, the strongest NAV performer, but it has generated a fair amount of income. Now, this is also important here because I want to look at the portfolio, so special opportunities. What on earth does that mean and what are they holding? Asset allocation here, so 104% stock, 18% bonds, a little bit of cash, some preferred stock, some convertible stock, and a whole pile of cash here that they are borrowing. A whole load of sectors there, some allocation here across different states of the US, some allocation here across different countries, primarily in the US for both equity and fixed income, but a little bit of a spread here amongst other countries for both equity and fixed income. So very diverse, but very much with a concentration of about 101% here in the US, and bearing in mind, of course, that this 101% is possible because of the use of leverage. When we begin to look here then at the top holdings, we can see, for example, General American Investors, we can see Central Securities Corporation, we can see Adams Diversified Equity. So we can see a few of these other well-known and regarded CEFs. But there is also, for example, the CION, Investment Corporation, a BDC, where they have invested. And I'll come back to a little bit of these holdings later on to explain what that all means. In terms of the credit quality here, it's not a pile of junk in terms of the credit quality. There is some fairly solid AAA, AA, and A level credit that they hold. There's also a huge amount not rated as well. When I look at all of this, this is very much sort of a hedge fund in terms of they've got a mixture of equities and credit. They've got a very long-term perspective. They've got a good, reasonably good spread here in terms of the investment holdings that they do have. And as we look down, I think this gives us a little bit of a sense of what's going on and how this fund is operating. Okay, so let's have a quick chat about these. Total Return Fund, I've never held it myself. This is fully 8% of their holdings. What exactly is that? It is a CEF. Now, I do know that it has a very large holding here in Berkshire Hathaway stock, and it does trade, I think, at a very comparable discount, in fact, to SPE at about close to 20% discount. It isn't an activist or an activism play. Now, special opportunities, a big part of what they do is activism. They buy into an investment, and then from this, they work to unlock or release value for themselves and other investors. So that's a big part of what they do. Now, SRH itself doesn't fulfill that criteria, but it does have a managed distribution payout plus a very attractive discount, but it isn't involved with that idea of activism. General American Investors, it's one of the big closed-end funds with a very good exposure to American equities. I think it's nearly 100 years old. And along with Central Securities Corporation is another very old one, and Adams Diversified here, ADX. When we look at what they say in one of their reports, they're basically saying that they hold these CEFs and it gives them a very broad-based exposure to US equities. They're buying at a discount, so they're looking for double discounts to the NAV. None of these are opportunities here for shareholder activism, but they do offer double-digit discounts to NAV. Now, one of the other benefits of this type of investing approach is you can buy when there's a very strong discount to the net asset value, and then when that discount closes, you can begin to close positions for profit. Okay, so at the moment, Special Opportunities SPE is looking more like a fund of funds, but there are a couple of key points here as well that we need to start looking at. For example, Texas Pacific Land Corp. Now, owns about 900,000 acres of land in West Texas and the Permian Basin. Now, this is an area and it's traditionally generated revenue through rental and royalty payments from the oil and gas producers in the region. So this is good. However, the Special Opportunities fund holder, the main activist here, Phil Goldstein, has said in the last annual report that, look, they believe that the Texas Pacific Land Corp as a holding is not generating sufficient value for shareholders. And so as a result, they think that many of the Texas Pacific Land Corp profits should be used to repurchase shares or be distributed to stockholders. Now, in particular, at the moment, there has been a lawsuit going on between the company and the largest shareholder, and this could be a catalyst when it's resolved for a movement higher in the Texas Pacific Land Corp value. CION investment, this is a BDC. It's a relatively small BDC. I've held shares in the past. It does have a very nice dividend payment here. Personally, I think for my personal portfolio as a direct holding, it is a little bit too risky for various reasons, but the shares are horribly undervalued, and I do recognise that. So that I think the shares are trading far below what they should be trading, and the management team here at CION has been undergoing share buybacks, which should be increasing value for shareholders here. First Trust Dynamic Europe Equity Income Fund. This is an interesting area where there is some opportunity here. So I think they've written about his opportunity here for a proxy contest and some litigation. What they say they've done here is they've actually reached out and they wanted to find out whether or not this could be converted to an open-ended fund. And that would unlock some value there. The board's not made any commitment to this, and so they looking to find out whether or not they're able to find any other solicitations there for proxies and trying to vote in some of the trustees that are not going to be focused on holding their position and needing to basically kiss ass for FDEU manager to maintain their position. So as an activist investor here, the Special Opportunities Fund is trying to get some independent trustees on the board here who are actually more likely to help vote for an open-ended fund structure. Now, is this going to be successful? I don't know. In about August or September, we should see the next shareholder report coming out, and we should find out whether or not we have some success here in terms of unlocking additional value for shareholders. As we begin to look through here, for example, and we're beginning to look at this 15% discount, one reason that it might be an interesting holding is the fact that it's already at a discount to the underlying net asset value. So even though the net asset values may fall at a large amount, they may not fall at such a pace that the market price, for example, doesn't necessarily fall quite as much as the net asset value, as we see here in the COVID crash as well. So I think it's one way of getting equity here at this discounted rate, and also at a point here where we can begin to collect monthly payments. I suspect, given the discount here as well, there's also the opportunity for the fund manager to buy back some of the shares here, unlocking value. And I think as well as that, if we begin to look at the basics here in terms of the leverage coming from the convertible preferred shares, there's also the opportunity to buy some of these back. Now, it's a little bit quirky and a little bit tricky, but these are currently trading at below their par value. And so immediately simply buying back those convertible shares will actually unlock value here for the shareholders. So if there's a buyback of the convertible shares, it will reduce the leverage. It will increase the value to the shareholders immediately, I think by about $2 per share that they buy back at the $25. So immediately, I think there's some opportunities here for the fund managers to do well for the shareholders. I think it's definitely an interesting opportunity here. It is definitely an opportunity for some reasonable distributions here at about 9% paid monthly. You're buying it at a discount to the asset values that are being held. What do you think? Is this an opportunity that you like the look of? Or is this an opportunity where you're going to stay on the sideline? Let me know in the comments down below. And also let me know your big pressing questions about closed-end funds, about CEFs, and about how to make these worthwhile investments. And I'll do my best to cover those all off in a new series focused on CEF investments. So let's get back into it very soon, my friends.